Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. Got an update, guys, for the uranium sector. We've had some humongous news, really, for all of this year. The fundamentals for the uranium sector continue to improve, and the price of the sector continues to get smashed and sold off, which is not unusual at all. It's a very rare sector, a very unique. It is a unique marketplace. So I'm going to be talking about that news and how we're positioning, and hopefully you enjoy what I have to say. Got a lot of charts, guys, so I'm going to be really punchy and get through it all. And any questions, you can leave it in the comments. If you haven't already liked and subscribed, I would appreciate you doing that. And if you're not familiar with the channel, I manage I have a portfolio on eToro, and I also have a derivatives book outside of that, which I manage as well. So without further ado, let's get into it. We're talking about URA, the Uranium ETF. It is not actually my favorite uranium ETF or my favorite way to play the sector, but it is the best way available on eToro. And so hence why we will focus on this. I personally prefer the Sprott Uranium ETF, URNM. And so I also am long that in various ways in my other portfolios. So let's talk about the news. So the big one recently is that the EU Parliament votes to designate gas and nuclear as sustainable. So that's just been taken from a straight headline. If you're involved in the space, no doubt you already know of this. And this is extremely important because one of the big obstacles for institutional capital entering into the space was the fact that the green sector, particularly in Europe, particularly in Germany specifically, was against nuclear power. So they have been shutting that down for the better part of a decade. And so they have led themselves into a position such that they have relied on solar and wind power, which of course has a very, very low energy return on energy investment. And so they're extremely inefficient ways of creating power, and they're insufficient in terms of providing baseload grid power to a nation the size of Germany, in particular, where they have placed the solar panels is in places where you have a huge redundancy because the sun doesn't shine. That is an issue when you have solar. In any case, with everything that's occurred as of February 24th this year, with Russia, that being 2022, depending on when you're watching this, Russia invading the Ukraine, Germany has really felt the pinch of being quite so reliant on Russian natural gas. And as such, they've been left in a really bad position. They've imported nuclear power from France for many years, even though they've shut down their own power. And now they have returned to using coal. So it's really just been a disastrous situation. And as such, the EU finally is starting to recognize that they need to remedy the situation. And so that they have declared energy from natural gas and nuclear as sustainable, and let's call it ESG friendly. Natural gas, if you're not familiar, is much cleaner than certainly coal, and it's one of the cleaner fossil fuels. So it's being used at the moment as a transition energy source, okay, which is great. Nuclear, of course, is at the moment, as far as we know as humans, really the highest energy return on energy investment that we have, and it also emits zero greenhouse emissions. So it is certainly, in my opinion, the way of the future, but I've spoken about that ad nauseum in other videos, so you can check that out. A very interesting scenario with potential sanctions on Russian-enriched uranium in the United States. The United States has now recognized that uranium is a scarce and sensitive material, so it needs to be treated as a matter of national security in order to continue to have access to energy, with energy being potentially used as the most potent weapon of war if things are starting to get more and more hairy and scary. Obviously, sovereign nations around the world are going to look to secure their supply of energy. They've learned the lesson that certainly Germany and the rest of Europe have learned quite recently. So with that coming on board, there's a lot still that's up in the air. But if you take out that Russian supply, that will really put pressure on an already existing supply dearth, okay, which will tend to send prices even higher. The big issue with this really now is that institutions and ESG funds, okay, this massive ocean of capital, now have a politically acceptable reason to enter into the uranium sector, okay? And this cannot be understated. If you look at the size of the respective market capitalizations, okay, if you, think of it as just the amount of money in any available sector. ESG funds at the moment at around about 35 trillion as of 2022, being an article at 2020, excuse me, as an article that I read. And it's expected to grow to about 50 trillion by 2050. So it is an awful lot of capital. And if you think about how small the market capitalization of uranium as a sector is currently, it's around 50 billion in total. Okay, so 50 billion in total for the whole, across the whole sector. You know, looking out over the next 2 decades, 2 to 3 decades, if the uranium sector were only to gain, you know, a fraction of a percentage of that capital, it will, I don't want to say blow up because that's not a good phrase to use with uranium, but it will absolutely send prices skyrocketing. Okay, it's just, you're trying to siphon Hoover Dam through a garden hose, as Doug Casey would say. I mean, there's just not that many different options to choose from in the sector, and that amount of capital, you know, funneling in will be a sight to behold, I do expect. The US are extending power plant life because they're struggling with oil and gas prices. It tried way too early to reduce, not reduce, really eliminate fossil fuel for energy gain, which is crazy. And so even in places like California, you've got, I believe, Diablo Canyon, which was due to be decommissioned, has now been extended. And the big one, Japanese restarts are occurring. And why is that such a big deal? Because instead of these old paused or decommissioned power plants holding the supply, that supply and feeding it into the market, that supply has now been taken away from the market. Precisely at the same time where that now becomes demand, because these reactors are coming back online, they're going to need more and more uranium with which to power those plants. Okay, miners are underperforming the spot, and recently you've seen pounds being purchased off an already presumably tight spot market, whilst the Sprott Physical Uranium Trust haven't been buying. So they've been seen, and rightly so, as the catalyst for taking a lot of uranium off the market. And from my perspective, if we're seeing, which we have seen, the price can start to rise in the spot market without SPUT really being involved in buying, that suggests that we've got more buyers into the space. And with SPUT currently trading at a discount to its NAV, if you're buying SPUT, you're essentially buying uranium for less than its market price. The interesting thing about that is the way that the trust is structured. When the trust trades at a premium to NAV, they issue more shares, and the proceeds of which are used to buy uranium from the spot market. So at a discount, they're chilling there. They will wait for that to be rectified, and then they will start to have this process of reflexivity, if you listen to George Soros, where they issue proceeds that gets used as buying physical uranium from the spot market, which bids the price up, which bids the net asset value up, and then they start to form this virtuous cycle. So very interesting times in terms of the uranium sector with the big sell-off in the miners. Let's talk about sector exposure. So as with any basically any commodity, you've got your physical and you've got your producers or miners of all stages. So your miners might be mines already in production, developers, they've got a lease on land where they've done drill results and they know they've got the particular commodity for which they're looking for. And you've got your explorers that are going to get a heap of capital together, go out, lease some land and drill for, in this case, uranium. If we look at the physical, quick recap, I've done work on this before, so I'm not going to belabor the point. You've got a cost of production generally around $60 per pound of uranium. So that's how much it costs all in to get out a pound of uranium. That doesn't apply to Kazatomprom. They are the low-cost producer in the sector, I believe. Incentive price is around about $70 to $80. Having listened to John Borshoff, he believes it's more around the $80 mark. If you're a junior, you really need to see high prices that would allow you the confidence to start to drill and develop a mine. It's a very expensive process. And the thing is, that will need to be an average. It won't just be the case where, the first day the spot market ticks over $80 that you'll see Deep Yellow and Bannerman and all these explorers or developers start to turn over dirt. They're going to need to see the spot price in that area at an average for longer and have a locked-in term contract for the utilities. But of course, before the utilities are going to want to sign such contracts at such prices, they're going to need to feel the pressure, basically. Sprott Equity Research, if you look at their models, they've modeled out $60. Okay, so if you're looking at doing modeling out for different deposits or different producers, $60 would seem to be fairly prudent. The current spot price as of yesterday closed at $47.50. And as I mentioned, spot trades at a discount to spot. And there's a problem with the charger. Okay. Here we've got an article talking about the ESG asset and funds flow at the moment and where they're expected to be over the next couple of decades. Okay, so a quick reminder of URA ETF. So what is in this thing that I'm buying basically for the eToro fund? So we've got Cameco is more than a fifth of the portfolio, and it's kind of like the bellwether. Being in a Western jurisdiction, it's the one big, fairly low-cost producer that people look towards. That's where institutional capital will start to go first. So it's fair to have it weighted. I probably wouldn't weight it quite so heavily personally, but I didn't make up the ETF. So there you go. SPUT, the Sprott Physical Uranium Trust, at around 7%. So that's buying physical yellow cake. Okay, so obviously you can't just store it in your bedroom. That is a vehicle, one of only a few, the other being yellow cake, which trades on the London Stock Exchange, which you can see down here, makes up lesser percentage, where you have the physical commodity. Okay, so they buy the yellow cake, they put it in drums and keep it in the warehouse. Next gen is, from what I can gather, the best deposit in the world to be developed. Paladin and Mitsubishi, you can go all the way through and see these different types of deposits. And further down here, I'll point out that Macquarie and BHP, you have access to some, it's not pure exposure to uranium. Okay, so you have access to some other commodities there, which is why I think personally the Sprott physical, the Sprott miners, URNM, is a better ETF. But anyway, it is what it is. Talking about spot, here we've got price action, and here we've got discount to NAV. So you're buying it at, basically call it a 10% discount to what you can buy yellow cake on the market, if you were to buy the futures, that is. As you can see, they've grown their NAV since inception at a really astonishing rate, and you can see how much uranium, physical uranium, that they are sequestering. And I just think that this is an incredible opportunity to get access to a sector in which I believe quite strongly personally, considering where we are in terms of global markets and what we need as humans from a humanitarian perspective. We need as much energy from as many different sources as we can efficiently and effectively provide and get our hands on. Okay, it's chart time. Okay, so here we go. Here we've got the futures contract. Okay, as you can see, we're starting to pick up. Okay, the last time, so we were here back in, I believe it was about August last year, but prior to that, the last time we tested $47 was back here in late 2012. Okay, just before 2013. Here I've measured the URA ETF versus the futures contract. Okay, so the price of purely uranium, and so you can see it's trading extraordinarily cheaply at the moment. So this is a recent view. When the price action is low, it means that the miners effectively, I know URA has physical in it, as I just mentioned, but it's mainly miners are performing, underperforming the physical commodity, or the futures represented by the futures in this case. And when, you know, the line is up here, it's the other way around. Okay. And so as you see uranium physical price start to rise in the spot market, you would expect that uranium shares will start to increase because they have leverage to the underlying commodity. Okay, same ratio, just taken over a longer time frame. So 2011, and then we had Fukushima, and everything started to go very pear-shaped. But these are the types of gains which we could certainly see in terms of a reversion of relative valuation from producers and developers, explorers, etc., to the physical product or commodity. Okay, URA on price action. What I wanted to show here is that we've come down. As I mentioned in my previous video, I was targeting this 200-day moving average, where I started to really increase our position in terms of URA, and that's exactly what has happened. We may, I think we've come back up to $19. I'm hoping that we come down again and we shall be able to buy more. Currently, the assets are around about 8% of the portfolio, and I'd like to increase it another 1 or 2%. Okay, and again, this is a history going back to 2011, and it gives you, I guess, a historical perspective of the price action. Okay, so here we've got all these things. Will we get straight back up to, you know, $100 for URA? I doubt it, given the dilution that occurs. So when you have a cyclical downturn, these guys have to issue a lot of shares, which dilutes the equity holding in order to survive the bear market. So as we can see, volumes are starting to flow into the sector. The counter argument to that would be, if we have an amount of capital entering the sector that I just mentioned through the ESG funds, that would more than compensate for the dilution that's occurred over the last decade. So that'll be interesting to see what happens. In any case, I think that if we were to have occur what I think we're going to have occur, $50 could be a reasonably high conviction target, let's say. Okay, URX tracking along with the futures, okay, over the last 5 years. I've just put a few little marks here that I think are important. It's important to see where we are in terms of the producers versus what the producers sell. Okay, so this little mark here, okay, is the last time where we were at around $47. And you'll notice that although the URA ETF is currently trading at $19, previously, when uranium was at the same price, it was just shy of $28. Okay, and similarly, again, the time before that, it was trading a tick under $28. Okay, yes, discount rates have changed with interest rates rising, but it's interesting to note a little bit of disconnect. Okay, and again, here we have over a little more than a yearly chart for the futures versus URA, okay? And obviously the physical has outperformed. Eventually, I do expect that gap to close where you've seen here, okay? And then eventually, as the bull market really kicks off, you'll have, if you follow my cursor here, this type of situation where the miners are actually outperforming the physical, okay? If you own a banana store and bananas, the price of bananas is going through the roof, but your business somehow hasn't been marked up in price, there's a disconnect there. Okay, and so this is what we've seen with coal massively over the last 2 years. The futures went up through the roof before the producers even started to move upwards and close a massive gap of what they call alligator jaws. So I would expect this to start to close. And then we have it. I hope you enjoyed that. Trying to keep it punchy. Verdict is I'm still long uranium and will be for 5 to possibly 10 years, barring any unforeseen circumstances. Long, roughly 10% or less. So I'll cap it out at 10% of assets under management. Why do I do that? Because we're using an ETF to get exposure, and it has broad exposure to both the physical producers, developers, and explorers, all in one product. And you have a little bit of extra exposure to physical and base metals. As you see, that BHP is in there. And the other source of diversification would be geographic diversification. So you've got a little bit in Kazakhstan and Canada and Australia and China and wherever else. Okay, so it is, well, it's really the only way to get broad sector exposure in eToro, but it's not a bad way. I believe that URNM is better, but as I mentioned, I don't have access to that. So I'm sticking with and adding to my position in conviction with the sector. The fundamentals for the market continue to improve whilst the sell-off occurs. And that's just been the case with energy as a whole over the last quarter. Thanks for watching, guys. If you enjoyed, please do like and subscribe. And if you're interested in a value fund, contrarian fund, you can find the portfolio on eToro. You can copy it if you wish, or you can just simply add us to a watch list. And if you've got any comments, I'd love you to leave them in the comments section. Important to note, of course, I'm not a financial advisor. This is not none of this is financial advice. The entire channel, every time you hear me speak, please do not confuse it as advice. This is just an outlet for me giving my opinion, what I think, and what I'm doing personally. But that does not make it right, and it doesn't make it right for you necessarily. You need to do your own due diligence and take responsibility for your own financial future and for your actions in general. Having said that, I hope that you enjoy it, and I look forward to seeing you, hopefully, in another video.